Greetings. Howdy, folks. Welcome to the Liberty Call. It is Tuesday, September 6th, 2022. Hope everyone had a fantastic Labor Day weekend. Mine was feeling under the weather. Like I said last week, I'm behind on my treatment for my inflammatory disease and felt like crap and was really hot here too. Oh, gosh, my beard's all fluffy. It was really warm here over the weekend, and we don't have air conditioning, so a lot of sweating, and wound up having to go get an IV last night to help with the dehydration. So I was feeling like hell. My heart was just palpitations. It was feeling like hell. Anyways, I'm alive, feeling good. But yeah, the warm weather, and we still have another 3 or 4 more days of it. That El Nino over in the West has really brought a ton of heat this way, which we'd had several weeks of very pleasant, 70-degree weather. It was really, really nice outside. Cooled off, had to close the windows at night because it was getting too cool already. But this week and late part of last week, it's just been miserable. So, but we got 70s and 40-degree nights ahead of us coming up this weekend. So I am very excited. So if it's your first time watching, please give me a big old thumbs up, like, share, subscribe, smash that whatever button to make sure you get notified that I'm live. And we've got some, well, I don't know if it's good news, but the market today was mostly down from the way it looks, just on looking across the indices. The rest of the world, kind of mixed. So, all right, well, let's go ahead and jump in. Today, we're going to go through what we normally go through yesterday on Mondays, the weekly economic update. Got a couple white papers, the market recap, article about the dollar gaining. We think that'd be a good thing, but it's kind of not. And, some news about lithium and the housing market. So a lot of material to get through. So let's go ahead and jump in. All right. Dow Jones was down. It was down 0.55% or 173 points, closed at 31,145. S&P 500 was down 0.35, closed at 3910. NASDAQ down 0.74, closed at 11,544. Small caps were down 1 1/4. The VIX was up 3.54% today. It's currently sitting at 2691. Moving over to the other Americas, Canada down 0.95, Brazil down 2.22, Mexico down 0.35. Headed over to Europe, Germany up 0.87, UK up 0.18, France up 0.19, Euro Stoxx was up 0.29, Netherlands was up 0.17, Spain was down 0.26, Italy flat at 0, Switzerland up 0.14, Portugal down 0.63. It looks like the Iberian Peninsula had a bad day. Moving further east, both Russian markets were down today. The MOEX down 2.54. The RTSI was down 2.74. Going over to Asia, Japan was basically flat, finished the day up 0.03. Australia down 0.38. New Zealand down 0.1. The Chinese markets look pretty good. The Shanghai was up 1.36. The SESE component up 1.04. China 50 up 0.38. DJ Shanghai up 1.4%. And the lone red for the Chinese markets, the Hang Seng was down 0.12. And the Taiwan weighted came in up 0.11. So like I said, it was kind of a mixed day across the globe, but certainly nothing too terrible. All right. Well, let's go ahead and run through this week's weekly economic update. The week on Wall Street, the overhang of Fed Chair Powell's Jackson Hole speech the previous week carried over into last week as investors recalibrated stock valuations amid a seemingly more assertive monetary policy stance. Again, I don't know why anyone was shocked by this. Let me move this over. I don't know. Like I said, I don't know. I really don't understand why anyone is surprised. I mean, inflation's still high. The Fed hasn't really done anything but throw small cups of water at a raging fire. So anyways, the Dow Jones Industrial Average fell 2.99%, while the S&P 500 stumbled 3.29. NASDAQ lost 4.21, and international slid 4.9. stocks extend losses. Investors remained unnerved by the aggressive tone of Jerome Powell's speech and subsequent comments from Fed officials suggesting a higher rate hike than the market expected at the Fed two-day meeting ending September 21st. The probability of a 75 basis point hike in September rose to nearly 65%, up from 28% a month ago. Stocks moved steadily lower before finding some footing on Thursday. Friday's employment report appeared to strike a Goldilocks note. Labor gains not as strong that it might trigger greater Fed hawkishness, but robust enough to allay imminent recession fears. For early gains, stocks turned lower ahead of the holiday weekend. Employment shines. Employers added 315,000 jobs in August, maintaining the labor market's remarkable resiliency amid a contracting economy. The unemployment rate rose to 3.7%, up from last month's 3.5%. The gain followed an uptick in the labor participation rate, which expanded from 62.1% to 62.4%. Wages continued to grow, rising 0.3% in August and 5.2% from 12 months ago. Sectors seeing the most significant increases in new jobs were professional and business services, healthcare, and retail. Lagging sectors were manufacturing, financial, and wholesale trade. I got just a couple of bits of economic data this week. Tuesday, we have the Institute for Supply Management Services Index, and Thursday is jobless claims. We have just 3 companies reporting earnings this week. On Thursday, we have Zscaler Inc., DocuSign, and on Friday, we have Kroger. All right. So, it's certainly not the end of the world. Things are not great, but it could certainly be a lot worse. If the fools in Washington would disappear, I think we could probably get everything back on track without all the needless regulation that hampers our lives. But again, there's too many people in this country who like free stuff, and they keep voting for these idiots. All right. Got, like I said, 2 white papers. First one up, 5 retirement concerns too often overlooked. Retirement is undeniably a major life and financial transition. Even so, baby boomers can run the risk of growing nonchalant about some of the financial challenges that retirement poses, for not all are immediately obvious. In looking forward to their second acts, boomers may overlook a few matters that a thorough retirement strategy needs to address. First is RMDs. The Internal Revenue Service directs seniors to withdraw money from qualified retirement accounts after age 72. This class of accounts includes traditional IRAs, employer-sponsored plans like your 401k, and these drawdowns are officially termed required minimum distributions, or as we in the business call them, RMDs. Next up, taxes. Speaking of RMDs, the income from an RMD is fully taxable and cannot be rolled over into a Roth IRA. The income is certainly a plus, but it may also send a retiree into a higher income tax bracket for the year. Retirement does not necessarily imply reduced taxes. While people may earn less in retirement than they once did, many forms of income are taxable. RMDs, investment income, and dividends, most pensions, and even a portion of Social Security income, depending on the taxpayer's total income and filing status. Of course, once a mortgage is paid off, a retiree loses the chance to take a significant mortgage interest deduction. Healthcare costs. Those who retire in reasonably good health may not be inclined to think about healthcare crises, but they could occur sooner rather than later, and they could be costly. A report by HealthView Services found that even with additional insurance coverages such as Medicare Part D, Medigap, and dental insurance, a healthy 65-year-old couple can expect to pay almost $208,000 out of pocket for healthcare expenses. I assume that's over a lifetime. Elder care needs. Those who live longer or face health complications will probably need some long-term care. 1 month stay in a private room in a nursing home costs an average of $9,000 annually, so it's important to consider these when preparing for retirement. Long-term care insurance is expensive, though, and can be difficult to obtain. One other end-of-life expense many retirees overlook: funeral and burial costs. Preparing to address this expense may help surviving spouses and children. Rising consumer prices. Historically, healthcare costs inflation has risen between 1.5 to 2 times the consumer price index. For a 65-year-old couple, this equates to an additional projected $85,917 in lifetime retirement healthcare costs. Retirees would be wise to invest in ways that help give them the potential to keep up with increasing consumer costs. As part of a preparation for retirement, give these matters some thought. Enjoy the here and now, but recognize the potential for these factors to impact your financial future. All good things to think about. All right, next up, should you prepare to retire on 80% of your income? That's typically what most planners and advisors, it's kind of a rule of thumb. It's not exact. It's more helpful, when you're working with someone in their 30s through 50s to kind of gauge, where they're at, what they're shooting for, especially the closer you get to that date. It allows you to, someone who's, say, 55 and they've kind of got all their things that they want in life as far as house, car, toys. You can kind of really gauge what their lifestyle needs will be once they're no longer working. So, but again, it's a rule of thumb. It's not a hard, fast rule. The classic retirement preparation rule states that you should retire on 80% of your income earned in your last year of work. Is this axiom still true, or does it need reconsidering? Some new research suggests that retirees may not need that much annual income to keep up with their standard of living. The 80% rule is just really just a guideline. It refers to 80% of a retiree's final yearly gross income rather than his or her net pay. The difference between gross income and wages after withholdings and taxes is significant to say the least. The major financial change for the new retiree is how to replace his or her paycheck, not his or her gross income. So concluded Texas Tech University professor Michael Fink, who analyzed the 80% rule and published his conclusions in Research, a magazine for financial services and industry professionals. Finke noted 4 factors that the 80% rule does not recognize. 1, retirees no longer need to direct part of their incomes into retirement accounts. 2, they no longer involuntarily, I like that, contribute to Social Security and Medicare as they did while working. 3, most retirees do not have a daily commute nor the daily expense that accompany it. 4, people often retire into a lower income tax bracket. Given all these factors, Finke concluded that the typical retiree could probably sustain their lifestyle with no more than 77% of in salary or 60% of his or her annual lifetime income. Retirees need to determine the expenses that will diminish in retirement. That determination, rather than a simple rule of thumb, will help them realize the level of income they need. Imagine 2 60-year-old workers, both earning identical salaries at the same firm. One currently directs 25% of her pay into a workplace retirement strategy. The other directs just 5% of her pay into that strategy. The worker deferring 25% of her salary into retirement savings needs to replace a lower percentage of their pay in retirement than the worker only deferring 5% of hers. Relatively speaking, the more avid retirement saver is already used to living on less. This is a hypothetical example used for illustrative purposes only. It's not to represent any specific investment or combination of investments. New retirees may not necessarily find themselves living on less. The retirement experience differs for everyone. So does retiree personal spending. A recent Employee Benefit Research Institute survey found that over a third of retirees report spending more than they had originally expected. Only 9% reported that they were spending less than they had expected. A timeline of a typical retiree spending resembles a smile. A 2013 study from investment research firm Morningstar noted that a retiree's household inflation-adjusted spending usually dips at the start of retirement, bottoms out in the middle and of the retirement experience, and then increases towards the very end. A retirement budget is a very good idea. There will be some out-of-budget costs, of course, ranging from the pleasant to the unpleasant. These financial exceptions aside, abiding by a monthly budget with or without the use of free online tools may help you rein in any questionable spending. Any retirement income strategy should be personalized. Your own strategy should be based on an accurate, detailed assessment of your income needs and your available income resources. That information will help you discern just how much income you will need when retired. Again, all these things you should be thinking about on a regular basis. Alrighty, well, let's go ahead and run through today's market recap. Stock market today, Dow stumbles as stronger data stoke larger rate hike fears. The S&P 500 fell Tuesday after swinging between gains and losses as tech struggled to fight off a jump in Treasury yields following a stronger than expected economic data. Tech was pushed lower as big tech wavered after better than expected services data kept the prospect of an aggressive Fed later this month front and center. The ISM Services Index inched higher to 56.9 from 56.7, above the consensus of 55.1. The odds of a 75 basis point hike climbed to 75%, up from 63% a day earlier, according to Investing.com's Fed Rate Monitor tool. Treasury yields rose sharply following the strong economic data, with the 10-year Treasury yield rising to fresh 3-month highs. Apple, Microsoft, and Meta platforms flirted with gains and losses, but remained in the red. Sentiment on tech was also soured by a slump in Chinese tech stocks after new COVID restrictions rolled out in the tech hub of Shenzhen on Monday. Alibaba was among the biggest decliners, down more than 3%. Energy also played a role in the broader market malaise, pressured by falling oil prices as investors fret over the impact of COVID-19 lockdowns in China on demand. Industrials, however, were roughly unchanged on the day, supported by rising airline stocks on signs of robust air travel demand. About 2.4 million travelers on September 5th made their way through the U.S. Transportation Security Agency's checkpoints, 2.3 million seen pre-pandemic in 2019. Alaska Air Group, American Airlines, and United Airlines were in the green, with the latter up more than 3%. Bed Bath & Beyond, meanwhile, slipped more than 18% after the home goods retailer's chief financial officer, Gustavo Arnal, died by suicide on Friday. The dude jumped off an 18-story building. Wow. I mean, there's got to be better ways to go than that. In other news, Digital World Acquisition Corp., which last year struck a SPAC deal with Trump Media and Technology Group, fell more than 11% after it reportedly failed to win enough shareholder support for a 1-year extension to complete the deal. All right. So that's the daily recap. Got some news about the dollar. Looks like, the dollar has just been on a tear. Really the last 2 years. And while it's kind of a good, bad thing, but, I think the other currencies around the world are just falling apart. And that's what's leading to a lot of the dollar strength. Dollar gains, euro slips from further from parity. The dollar marched higher on Tuesday after a report on the U.S. services industry in August reinforced the view that the economy was not in recession, while the euro, a rate-sensitive Japanese yen, continued to tumble. The dollar index rose 0.557% after the Institute for Supply Management said its non-manufacturing PMI edged up to a reading of 56.9 last month from 56.7 in July, the second consecutive monthly increase after 3 months of declines. The growth in services followed the ISM's manufacturing survey last week that showed the U.S. factory activity grew steadily in August, in contrast to other major economies. Quote, people recognize the U.S. economy is slowing, but it's still the least ugly in the contest. As I like to say, the tallest midget in the room, said Mark Chandler, chief market strategist at Bannock Burn Global Forex. While the dollar's path of least resistance is upward, its strength will be challenged next week when the U.S. Consumer Price Index for August is released, Chandler said. Quote, the early call is for a decline in the month-over-month headline rate, he said, but the core rate will be stickier, end quote. The British pound and euro tried to recover from multi-year lows against the dollar hit on Monday. Central bank rate hikes are garnering the attention of the currency markets, with the Bank of Japan standing out at the Jackson Hole Symposium as the only one that remains resolute about keeping monetary policy accommodative, HSBC said in a note. The correlation of the dollar-yen exchange rate with the U.S. yields has rebounded to near its strongest year-to-year level, HSBC said. The bank changed its forecast for the pair to 144 at the end of the third quarter, up from the previous 140 previously. The yen weakened further, down 1.48% at 142.71 per dollar. The dollar is up 24% against the the Japanese currency so far this year. Yeah, it's as we increase rates, it's putting more downward pressure on the other major global currencies, and it's a real mess around the world. So while things seem okay right now, this could be foreshadowing of something worse. All right, for you folks who like your electric cars, this is titled "We Don't Have Enough Lithium Globally to Meet EV Targets," mining CEO says. This is not good news if you want to get away from combustion engines. Climate provisions in the Inflation Reduction Act put the U.S. back on track toward significant emissions reductions, potentially reducing greenhouse gases by up to 40% of 2005 levels. Yeah, okay, sure. But one miner warned that when it comes to the transportation sector, domestic resources for lithium, the most critical mineral used in the electric vehicle production, may not be sufficient enough to meet some of the most ambitious targets. The Biden administration, for instance, aims to slash the sale of gas-powered vehicles to 50% of all new purchases by 2030. I don't see that happening. Quote, yes, we'll eventually have enough, but not by that time, end quote. said Ken Phillips, CEO of Piedmont Lithium. He said in an interview with Yahoo Finance Live, and the video's above if you want to go back and watch it, quote, "There's going to be a real crunch to get the material. We don't have enough in the world to turn that much lithium production in the world by 2035, end quote. With the average electric car battery requiring roughly 8 to 10 kilograms of metal, lithium remains a crucial material in the transition to emission-free vehicles. Again, they're not that emission-free. You got to dig the crap out of the ground and mine it and replace it every 8 to 10 years. So again, it's not it's not emission free. Growing demand has caused the price of lithium carbonate to nearly double this year alone, and the IEA projects demand to grow by 40 times in the next 2 decades, with the majority of that supply coming from outside the U.S. That has complicated climate change targets set by the Biden administration. The president has called for half of all new vehicles sold by 2030 to be electric, setting aside billions of dollars in the Inflation Reduction Act to incentivize drivers to make the shift. Again, using the government force to force people to do things, that's where I have the problem. If you want to buy an electric car, I don't care. Doesn't bother me. Just don't force me to do it. But those same tax credits come with requirements calling for parts and components to be largely sourced in North America, leading some EV makers to push back against the goals on the grounds that they are not realistic. Piedmont Lithium is looking to cash in on the demand as one of only a handful of U.S.-based lithium miners. On Thursday, the mining company announced plans to open a lithium processing operation in Tennessee, with construction set to begin in 2023. Once fully operational, the plant will process 30,000 metric tons of lithium per year. The company is also planning another plant in North Carolina, which will allow the firm to supply lithium, for 1 million electric vehicles per year. Quote, "The world has changed," Phillips said. "We are now in an era where everyone's going to want an electric car. The car companies can't make them fast enough, and people are now looking for the lithium they need for the batteries to go in those electric cars," end quote. While car makers like General Motors have rushed to secure partnerships with domestic mining operations in anticipation of the demand, the Albemarle Silver Peak mine in Nevada remains the only operating lithium mine with meaningful output. Phillips said, "A slowing permitting process has stalled approvals for new production sites. Meanwhile, China has continued to dominate the industry, refining more than half of all lithium supply, while Australia and Chile remain the largest producers in the world. Projects get permitted in Australia in under a year," Phillips explained. Here it's 2, 4, 6, 7, 8 years, which is a problem, especially in a business that's booming fast. Again, government red tape, gotta love it. The White House has moved to accelerate the process by invoking the Defense Production Act to bolster production of minerals critical to EV manufacturing, including lithium and cobalt. The IRA also establishes the Advanced Production Investment Tax Credit for domestic production. But with the demand for EVs far outpacing and new mining operations, working within a 5 to 10 year timeline before coming online, Phillips said that as it stands, the U.S. cannot meet its clean energy targets with domestic production, domestic sourcing priority. Quote, "Energy security is a national issue," Phillips said. "I think you'll see companies that are thinking about battery plants in different parts of the world or lithium conversion plants coming to America because this investment tax credit will be very valuable. The market opportunity is huge." So again, I'm not opposed to people having electric cars. Do whatever you want. You're just not going to hold a gun to my head and tell me I can't drive my diesel truck. Sorry. It's just the way. It's America. It's a free country. Well, used to be. All right. Some news about housing. This comes from our friends at First Trust. Brian Westbury, their chief economist. Home prices plateauing, rents catching up. The housing sector surged during COVID in large part due to loose money. The Federal Reserve kept short-term rates artificially low, and the M2 measure of the money supply soared. Now, with rising short-term rates and slower growth in M2, sending mortgage rates higher, the housing sector has had a bad case of indigestion. Sales are down, construction is down, and the most recent reports on home prices show a sudden and sharp deceleration. This should sound familiar because it's very similar to what happened in real inflation-adjusted retail sales. Sales soared in 2021, but haven't since plateaued, as growth in consumer spending has come from services, not goods. Expect something similar in the next 5 years with housing, with the national average home price roughly unchanged while rents continue to catch up. Recent problems in the housing sector are widespread. Existing home sales have dropped for 6 straight months, and with the exception of the first few months of COVID, are the slowest since 2015. New home sales are at the slowest level since early 2016, even if you include the horrible first few months of COVID. Private residential construction rose for 24 straight months through May and has now since declined for 2 straight months. Meanwhile, after peaking at 1.805 million annual rate in April, housing starts fell almost 20% to a 1.446 million rate in July. In time, fewer housing starts today will lead to less overall construction and home completions later this year. But perhaps the most dramatic change is on prices. The National Case-Shiller Index rose more than 1% in every month from August of 2020 to May of 2022. Every single month, home prices rose a total of 8.9% in the first 5 months of 2022, more of the same. But then came June when prices rose a meager 0.3%. As a result, some are thinking we are in for a massive housing bust, the kind of which hit the U.S. after the last boom in the 2000s, but we think that's highly unlikely. Housing is going to feel some pain, but we are facing nothing like what happened in the last housing bust. I think that has more to do with better loan approval process and making sure people can actually afford to pay it back. I think that's probably why we're in much better shape. No more of those ninja loans that lenders were giving out 15 years ago. Last time the national average home price bottomed in 2012 was about 25% below where they had peaked in 2007. From the peak to the bottom, housing starts plummeted 79% and new home sales fell 80.6%. Those are not typos. Existing home sales dropped 52.3%. Mix all those changes with no market-to-market accounting, and no wonder we had a financial crisis and the Great Recession. That's not happening this time around. So why do we think we are not in for a huge housing disaster like last time? First, because the housing bust was preceded by several years of massive overbuilding. We simply had too many homes, too many homes available for sale, as well as too many homes available for rent. By contrast, the most recent turbulence in the housing market has not been preceded by overbuilding. If anything, we built too few homes in the past decade, not too many. Second, although home prices have risen substantially since 2020, relative to replacement costs, they're only up about 2% and only about 4% higher than the median in the past 40 years. No big deal. Why does replacement cost matter? Because the more it costs to replace your home, the more your current home is worth. So yes, home prices are up substantially, but if the costs of copper pipe, drywall, lumber, and labor are up too, then it makes some sense for home prices to be up as well. Third, rents should continue to rise at a rapid pace, putting a sturdier floor under home values. In the last housing crisis, not only did home prices fall, but housing rents decelerated sharply and then temporarily went negative as well. Think about that. Many people were leaving home ownership, but landlords couldn't squeeze them for more rent because there were simply too many homes. Now, in the current environment, where higher mortgage rates are persuading some potential homebuyers to remain renters, landlords are in a much stronger position. They can keep raising rents because the market isn't oversupplied with homes, and in turn, higher rents should keep home prices from falling like in the prior housing bust. The more a home can generate in rent, the more valuable the home. The bottom line is that what we are seeing right now in the housing market is a bad case of indigestion from higher interest rates due to overly loose monetary policy and other COVID-related policies. Home prices got too high versus rents in the past couple of years, and both prices and rents need to correct. We project continued gains in rents for the next few years as home prices are roughly unchanged. The maximum drop in home prices from the peak to the bottom of this cycle should be around 5%, not 25% implosion like last time. So that's a bit of good news. I mean, I guess if you're in the market right now looking to buy a house, probably not the best because everything's gotten more expensive. You may have to rent for a couple of years until interest rates stabilize, or just save up a sizable down payment so you can afford the home that you want. All right, well, that's everything I had for today. I hope everyone has a wonderful evening. We'll be back tomorrow with Wednesday's Liberty Call. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. If you want to book a meeting, send me an email, drop me a phone call. Hey, I don't care, whichever you prefer. All right. Well, hope everyone, like I said, has a great night, and I'll see you tomorrow. Bye.